We think silver's broken through every hurdle, technical hurdle we need to see to indicate it's restarting itself. Another major up leg. The last signal we're going to offer, and we get very specific with our subscribers, but basically it's if you get back over 25 again, put your helmet on. So if you look at a price chart, the last two highs, I think it was July and August, were just above 25. So getting back there again, somebody's going to say, well, let's sell it again. Better not. I think silver goes through that 25 level. It's going to take out 30 in a heartbeat. And I think silver is going to percent-wise vastly outperform gold over the next year.
Silver has shown significant volatility this year, marking a 6% year-to-date increase domestically. Similarly, gold has exhibited extremes on both ends of the spectrum and is now steadily gaining momentum, boasting an 11% year-to-date increase. In November, gold saw a slight upward movement, while silver gained 2%, aligning with the upsurge in industrial metals. In past precious metals bull markets, silver usually started slower than gold but gained momentum later. From 1970 to 1980, while gold surged over 2,500%, silver soared nearly 6,000%, showing its potential to outperform significantly in later market stages, despite initial lagging. The current daily price of silver, at 24.27, is positioned above both the 200-day and 50-day moving averages, which are at 23.47 and 23.04 respectively. This indicates a bullish trend, given that the price surpasses these significant long-term indicators. Additionally, the price hovers close to the minor resistance level of 24.50, indicating the potential for an upward breakout upon surpassing this point. It also comfortably exceeds the main support level of 22.23 and the minor support level of 23.55, reinforcing the bullish sentiment. According to Michael Oliver of Momentum Structural Analysis, silver has overcome several technical barriers, signaling the potential start of a major upward trend. He highlights a key signal for potential movement. If silver reclaims the $25 mark, it might pave the way for substantial growth, potentially surging past $30 quickly. He predicts silver could outpace gold in percentage gains over the coming year. Considering the potential impact of the silver-to-gold ratio, historical observations suggest that silver has surpassed certain percentages relative to gold's price. If gold were to follow similar ratio movements seen in previous years, potentially reaching $8,000, and if silver were to achieve even a fraction of that ratio, it could result in significant value gains for silver. Michael expresses confidence that silver is positioned for outperformance, especially in the late stages of the current bullish cycle initiated from the lows in 2015. We will present clips from Michael Oliver's interview with Commodity Culture. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
It's been a horrible 3 years of plateauing by silver. While gold went sideways with repeated highs over 2,000, silver went into a gradual declining trend channel, which we've actually sort of emerged out above if you look at just price even. Where you make a high at 30, you make a high at 28, you make a high at 26, make a high at, et cetera. So it's been gradually decaying with some nice spike lows down there. Like we were $17 last year, and now silver's what, 23, 24 zone. Well, percent-wise, that's a bigger move up off the low than gold is, off of its October low last year. But still, people have been moaning. I think silver goes through that 25 level. It's going to take out 30 in a heartbeat. And I think silver is going to percent-wise vastly outperform gold over the next year. And a major point we're making too. The prior bull trends in gold lasted about 9, 10 years or so. Like the early 70s, it was in the $30 zone, went to $850, okay, by 1980, okay. 2000, year 2000 was trading around $250. By 2011, it was $1920, okay. But a decade or so. Most of the percentage of the price gain of those bull markets came in the final year of the bull trend, meaning the 8th or 9th year or 10th year. We're now 8 years old, bottomed in late 2015 at 1,050. We've doubled since then in gold. Okay, so it hasn't had the ratio move of those moves, which were eightfold moves. We've only doubled. And yet we've got these macro fundamentals that could drive it a lot higher. But you've got to be careful because late in the trend, after laborious bull trend, that's when you get this engagement that is so dynamic that it takes your breath away. Back in 2010 or so to 2011, silver went from like 20 bucks to 50. Did most of its move in about 3/4 of a year. Same was true in 1979. Silver exploded and got up to 50, or, it did most of it in 3/4 of a year in 79. We're getting late in this bull trend too, so it wouldn't shock me that either 2024 or 2025 is that year where you get verticality, especially given the fundamental and technical dynamics in these other asset categories that will drive the Fed to liquidity issues again, which will fuel the gold move and silver. Ratio basis. Silver to gold, if you look back historically over the last 50 years, you'll see it's gone up to 6.5% of the price of gold. It's been multiple times well over 3% of the price of gold. So it's not like it's rare for it to be there. Right now, it's above 1% of the price of gold, like 1.3. If gold were to match the ratio moves that it had in 1970 and 1980, or 2000 to 2011, it would go to $8,000 and merely match the ratio, eightfold. If silver were even 2% of the price of gold or 3% of the price of gold, and gold was at 8,000, you do the math. It's off the page, hundreds of dollars. We don't think it's a ridiculous assertion. And I think that a lot of that is going to occur late in this bull cycle, which began again from the 2015 lows. So I think silver is going to be an outperformer.
The price of gold is attempting a slight rebound near $2,020 early Wednesday, echoing Tuesday's movement in Asian trading. After touching $2,020 earlier, gold rose to around $2,030. Following U.S. employment data, the benchmark 10-year U.S. Treasury bond yield fell below 4.15%, aiding gold's upward movement. Michael recently noted a significant correlation between T-bonds and gold, suggesting synchronized movements. In October, as gold dipped into the 1800s dollars, T-bonds took a worrying plunge below last October's lows, deviating from the expected U.S. government debt market behavior. The drop in T-bonds, resembling a collapsing commodity market, raises concerns, particularly for entities like the Federal Reserve. Michael anticipates a V-shaped T-bond recovery, aligning with gold's recent pattern, which might influence Federal Reserve policy. This recovery could indicate the market's perception that the Fed might avoid raising rates due to bond market vulnerability. While this notion might already be reflected in gold prices, it suggests broader market sentiment and hints at potential monetary measures like printing money and rate cuts if a paper asset bubble bursts. Let's get back to the interview.
The trend direction of T-bonds, and we're talking price now. So if price goes down, yield goes up. Okay, remember that. T-bonds we got bearish in 2020, late 2020, well before we got bearish on the stock market in early 2022. But bonds started a major bear market then, the yields rising. Okay. They made a low last October, a year ago, at a level that we predicted would be a bounce point, but only a bounce point. And sure enough, they had a nice bounce. They ran up nicely and they stabilized. Well, you'll notice last October, stock market also made a low, and so did gold. Gold was in the low 1600s. It was a bear trap low, we defined it as. Meaning, if you sold that downside breakage, you're caught in a bear trap. Okay, and sure enough, it exploded back to 2000 again. But during that same time, T-bonds rallied from the October low. S&P rallied. And T-bonds then leveled off and basically peaked around March or April of this year. It started to roll over again. What did gold do? Same thing. In other words, T-bonds were technically in linkage with gold, which was very interesting because it doesn't always happen, but sometimes it does. And we defined that months ago, that watch the T-bonds and gold because they seem to have their legs strapped together, almost week by week. And we made a difference, though, because we saw gold pulling back and it dropped into the 1800s, this October. Whereas T-bonds crashed. They didn't just go down. They took out last October's low, which would be like gold being below 1600 if it had matched it. And, well below there. And they did it in crash mode. There was the T-bond chart. If you looked at it, it looked like some collapsing commodity market. Didn't look like what the U.S. government debt market should be looking like. I know it had to vastly upset Yellen and the central bank and the Feds, because that's the asset they can't have crash. They don't care about NVIDIA or something like that. If that happens to go down, they couldn't care less. But their T-bond market, that's life or death for them. And so we argued that expect a V bottom in the T-bond market. And in fact, we've gotten one over the last month. Lag to gold. Gold turned up about a month before T-bonds did, but then T-bonds got back in sync with gold and had a sharp rally. Now, gold was back to its all-time highs, but T-bonds were having what we call a V bottom. And I think in part that was due to overnight buying by the Treasury and the Fed in the dark type buying. And there's also some very large asset managers out there who realized that while bonds were a horrible place to be last year, they were even worse than the stock market. So the 60-40 portfolio was lethal. That the bonds were oversold now and likely to be worth buying. And I think they plowed into the bond market. That's why you're getting this V bottom. But I suspect what it means is, and I think the broad market interprets it partly as one of the factors, the Fed can't raise rates anymore. No matter what they want to say, they cannot do it. They cannot destroy their bond market. At all costs, they have to print, whatever it takes to support that market. So I think the stock market right now is pricing that in. I think gold has all along priced that in, meaning it's always known that when the paper asset bubble breaks, stock market, the central bank will have to revert back to that which they do best, which is monetize debt, print money, cut rates at some point. That's why it keeps coming back to its highs. Find me a commodity, or find me any asset almost on the planet that has kept coming back to its highs. Gold is the one, okay? It has a reason for that. And we don't think it's going to stop at 2,000 this time, by the way. But I think that what happened to the T-bond market is critical in terms of the change in the Fed policy. Now the debate among analysts and stock analysts and talking heads on financial TV, it's not about whether they're going to stop raising rates. It's when are they going to cut? That's the debate now. And they're correct in that. I suspect it's going to be sometime in Q1, not Q2 of next year. But we'll see. But gold knows that. And gold is a monetary metal. It will reflect the degradation of the money unit.
According to Trading Economics Global macro models and analysts' expectations, silver is anticipated to reach 26.00 USDT Oz by the quarter's end. Market sentiment for silver seems bullish, supported by the price's alignment concerning moving averages and support resistance levels, suggesting strength and potential for additional gains. What do you expect the price of silver in 2024? Share your observations in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.